I was cleaning out my home office this weekend, which is really just a nice way of saying I was moving stacks of paper around. And I found this old folder.
Let me guess. The important documents folder.
Exactly. And, buried under some old tax returns was my life insurance policy.
Yeah.
And I just sort of looked at it and thought, great, checkbox ticked, family set.
Right. The set it and forget it mindset.
Yeah. It feels so binary. I have the paper, so I have the safety net.
And that feeling, that confidence is probably the single biggest risk to your family's financial future.
Okay, that's an ominous way to start.
Well, it has to be. Because if you treat life insurance like a receipt you get for a toaster, you're missing the point. It's not a product. It's a really dense, complex legal contract.
Full of trap doors, I'm guessing?
Exactly. That's a good way to put it. Trapdoors. So today we're unpacking a whole stack of material industry handbooks, actual policies from carriers like RBC and Foresters, legal reports. We're going to find out why a policy you've been paying into might pay out. Zero.
You're talking about denied claims.
Denied claims, yeah. And, danger zones where your coverage can just vanish, or even simple screw-ups that can get your money locked up for years.
That sounds genuinely terrifying, but I guess that's why we're here, to decode that fine print.
It is. And I want to be super clear from the start. The sources we're looking at, especially the CLHIA Consumer Guide, really stress that this is not a DIY project. You can't just guess your way through a financial needs analysis.
Right. And for this deep dive, we're pointing to Mansour at Muner's Financial Services as sort of the guide for this whole landscape.
A guide is what you need.
Yeah, Muner specializes in tailoring these plans so you don't fall into the exact traps we're about to talk about. If you want someone who knows where the landmines are buried, you should talk to Mansour. We'll give his details later, but just keep that in mind.
Good. So shall we start with the contestability period?
Let's do it. This was the first thing in the research that it made me sit up straight. I always thought if a policy's active, it's active. End of story. But the first 2 years are different.
Oh, very different. In Canada, the first 2 years of any life insurance policy are called the contestability period. Think of it like a probation period for your honesty.
Probation? That sounds like they're watching me.
In a way, they are, or at least they're waiting. If you die within those first 24 months, the insurance company doesn't just cut a check. It is completely standard procedure for them to launch an investigation.
An investigation? Into what?
A really thorough one. They'll pull all your medical records, your prescription history. They'll check the Medical Information Bureau. They can even pull your motor vehicle reports.
Wait, hold on. They'll investigate my driving record after I'm dead? Even if I die of, a heart attack?
Yep. They're looking for one thing. It's called material misrepresentation.
Okay, let's unpack that. Misrepresentation just sounds like a nice word for lying.
It can be lying, absolutely. But the key word there is material. A material fact is any bit of information that, had the insurer known it when you applied, would have caused them to do one of two things.
Which are?
Either decline your application outright or charge you a higher premium for the coverage.
Okay, so lying about being an astronaut is material. I get that.
Of course. But it's usually much more subtle. The absolute classic example is smoking.
Trying to get that sweet, sweet non-smoker discount.
Exactly. You tick the non-smoker box. Maybe you quit cigarettes years ago, but you vape on the weekends. Or, and this is a huge one now, you use cannabis.
Right, and a lot of people think, oh, that's just social, I'm not a smoker.
The insurance company completely disagrees. If you die in those first 2 years, even if it's a car crash that has nothing to do with your health and an autopsy, or your medical records show nicotine or THC, they can deny the claim.
Even if the smoking didn't kill me, that just feels so harsh.
It's all about the contract. Their argument is simple. If we knew you used nicotine, your premium would have been double. You paid the wrong price, so the contract is invalid.
So what happens then? Do they just keep all the premiums I paid?
No, they declare the policy void ab initio.
Void ab what now? That sounds like a magic spell.
Yep.
It's Latin. It means void from the beginning.
Okay.
So legally, they treat the policy as if it never, ever existed. They'll usually refund the premiums you paid, but the death benefit, that $1 million you thought you were leaving behind, it's gone.
That is the nightmare.
Yeah.
You think you're covered, but you've actually just been, making deposits into a void.
And it's not just smoking. It's that forgotten medical history. Oh, I didn't mention that blood pressure pill I took for a month 3 years ago. If they decide it's material and you die in that 2-year window, you've handed them a legal reason to deny the claim.
So the lesson is, don't guess. Don't hide anything.
Overshare. Tell them everything. Speeding tickets, weird rashes, all of it. Let their underwriter sort it out, because here's the upside. Once you get past that 2-year contestability period, the bar for them to deny a claim gets much, much higher.
How so?
After 2 years, they generally have to prove actual fraud, and that's a very high legal hurdle. But for those first 730 days, you are absolutely walking on eggshells. Okay, speaking of things that happen in those first 2 years, we have to touch on the really grim stuff, the exclusions.
Right. The suicide clause.
I think a lot of people have this idea in their head that life insurance just never covers suicide, period.
Which is a myth, but it's a myth that's rooted in a little bit of truth. The sources we looked at, like the policies from Foresters and RBC, they show that the suicide exclusion is almost always limited to those first 2 years.
So it's tied to that same contestability period.
Exactly. If it happens in year 1, no payout. The logic is to prevent what they call adverse selection. They don't want someone buying a policy on a Tuesday, planning to end their life on a Wednesday to solve a financial problem.
Right. I mean, it's dark, but from a purely business standpoint, that would bankrupt the whole system. I get it.
But here's a nuance I found interesting in the research. If the claim is denied for that reason in the first 2 years, they don't just keep your money.
They give the premiums back.
Typically, yes. Sometimes it's just the premiums paid, sometimes with a bit of interest. One source even mentioned a carrier that refunds 110% of premiums. They're not trying to profit from it. They're just not paying the death benefit.
And after 2 years pass.
After 2 years, the view changes. The assumption is that the original intent wasn't fraudulent. Life happens. Mental health is a real struggle. So generally, after that 2-year exclusion period, suicide is covered like any other cause of death.
That's a really heavy but very important distinction. Okay, now, moving from the tragic to the criminal. The Slayer's rule.
This is straight out of a TV show. It's a fundamental legal principle. You cannot profit from your own crime.
So if the beneficiary offs the insured person for the money,
They get nothing. Zero.
Nah.
The money just bypasses them and goes to the estate or the next person in line.
simple enough. But let's look at one exclusion that feels a lot more relevant in the world right now, the war exclusion.
This is a big point of confusion. People tend to lump war and terrorism together.
I think most people do, yeah. An act of war sounds like it covers everything from a battlefield to an attack in a city.
But the sources are very clear. Standard policies often have a war exclusion clause. It says that if you die as a result of war or insurrection or while serving in the military in a conflict, you're not covered.
So if I'm a civilian and I decide to go backpacking through an active war zone and something happens,
Your standard policy will almost certainly deny that claim. You knowingly entered an excluded high-risk area.
but what about terrorism? What if I'm on vacation in, say, Paris and there's a tragic, isolated attack?
Generally, that is covered.
Why? What's the difference?
It all comes down to something called solvency risk. A full-scale war could cause thousands, maybe millions of deaths. An event like that could actually bankrupt an insurance company. But terrorism, as tragic as it is usually localized. It doesn't threaten the entire financial stability of the insurer, so they don't typically exclude it.
So, war is a no, terrorism is usually a yes. What about people who are actually in the military? Reservists, active duty folks listening right now.
This is critical. If you're in the Canadian Armed Forces, relying on a regular commercial policy you bought online is incredibly risky. The sources specifically mention SISIP,
SISIP.
this Service Income Security Insurance Plan. It's the plan specifically for the forces. It's designed to remove the war exclusion. If you're deployed, you need a policy that understands that risk.
Yeah.
Your off-the-shelf plan might leave your family with nothing.
It all comes back to reading the fine print. Okay, let's shift to something that probably affects way more people.
The administrative nightmare.
The lapse.
This is the #1 most common way people lose their coverage. And it's so frustrating because it's almost always preventable.
Okay, so walk me through it. My credit card on file expires, the payment fails, my policy doesn't just poof, disappear. Right.
No, you have a grace period. The policies we looked at, like from RBC and Foresters, usually give you 30 or 31 days. If you die during that 1-month window, they'll still pay the claim. They'll just subtract the premium you owe them.
Okay, fair enough. They take their cut.
But the second that grace period ends on day 32, the policy lapses. It's gone. It's dead.
Can you get it back?
You can apply for what's called reinstatement, usually within a couple of years. But here's the trap. First, you have to pay back every single missed premium, plus interest.
Okay. That could be expensive, but maybe doable.
But the second part is the real kicker.
Yeah.
You have to prove you're still healthy. You need to submit new medical evidence.
Oh, I see where this is going.
Let's say you stop paying because you got a serious diagnosis, lost your job, couldn't afford it. Now, because you're sick, you really want that insurance back.
And they'll just say, sorry, you don't qualify anymore.
Exactly. The very moment you need it the most is the moment you can't get it back.
Yeah.
But it gets even worse. There's what we call the double jeopardy of reinstatement. Remember that 2-year contestability period we started with? The investigation window.
Yeah, the probation period.
When you reinstate a lapsed policy, that clock often starts all over again.
You are kidding me.
I'm not. So you could have a policy for 20 years, solid gold, no investigations possible. You let it lapse for 3 months, then you reinstate it. 6 months later, you die. The insurance company can now investigate that reinstatement application like you're a brand new customer.
So you threw away 20 years of being in the clear.
You did. Keeping an old policy going is always safer than letting it lapse and trying to fix it later.
Is there any kind of safety feature for this? I mean, people miss emails, cards get compromised.
Yes. If you have a permanent policy one with a cash value, there's a feature you have to make sure is turned on. It's called an automatic premium loan, or APL.
How does that work?
It's exactly what it sounds like. If you miss a payment, the insurance company automatically lends you the money from your own policy's cash value to pay the premium for you.
So it basically pays for itself for a while.
Exactly. It keeps the policy from lapsing. It buys you time to sort out the payment issue without resetting that whole contestability clock.
That feels like a setting everyone should go check on their policy, like today.
It absolutely is.
Okay, last piece of the puzzle. Who actually gets the money? Beneficiaries.
This is where family disputes start. And it's usually because the policy owner didn't get the difference between revocable and irrevocable.
Okay, break that down.
Revocable is standard.
Yeah.
You, the owner, can change it anytime. Get divorced, you log in and take your ex off the policy. Easy.
And irrevocable.
Once you name someone an irrevocable beneficiary, you've just lost control of your own policy. You can't change the beneficiary, can't cancel the policy, you can't even borrow from it without that person's written permission.
Why would anyone ever do that? It sounds like you're handcuffing yourself.
2 words. Divorce settlements.
Ah.
It's really common. A court orders one spouse to maintain insurance to secure support payments. Naming the ex-spouse as an irrevocable beneficiary ensures the policy owner can't just secretly cancel it later. It's a lockbox.
Makes sense. But you said there's a bigger mistake people make.
The minor problem.
Naming your kids as beneficiaries.
Yes. People think, I love my daughter, I want her to have this money. So they write her name on the form. She's 10 years old.
And what happens if the parent dies?
The insurance company, by law, cannot write $1 million check to a 10-year-old. They just can't do it.
So, where does the money go?
It goes to the government. The funds are paid to the court, to the office of the children's lawyer, or the public trustee.
That sounds like a bureaucratic nightmare.
It is. The money is locked away in a government-run account until the child turns 18. The surviving parent, the spouse, might need that money now for the mortgage, for groceries, for the kid's school.
And they can't get it.
They have to apply to the court to get access to their own kid's money, prove it's for the child's benefit. It's a mess.
So you have a grieving spouse who can't pay the bills because the insurance money is stuck in a government account.
We see it. It happens. And it's so easily preventable.
So how do you fix it?
You need a trustee clause. You name the child, but you add in trust for, and you name a responsible adult as the trustee. That way the check goes to the trustee and the money's available right away to care for the child.
This is, honestly, it's overwhelming. From void ab initio to automatic premium loans, it's clear life insurance is a powerful tool, but man, is it fragile.
It's a contract. If you break the terms by not telling the truth, by not paying, by not updating it, it fails.
And all this complexity is exactly why the click here to buy insurance online is so risky. You might accidentally buy a policy that excludes your main hobby, or you might make that mistake with your kid's name.
And you won't know you made the mistake until it's far too late to fix it.
Which is why we said at the start you need a guide. The CLHIA guide talks about doing a financial needs analysis, but that's not just some online calculator.
No, it's a real process. You need a specialist.
Right. And if you're listening to this and you're thinking, I have no idea if my policy has a war exclusion or did I mess up the beneficiary for my kids? Boo, you really need to talk to Mansoor at Muneris Financial Services.
Muneris is all about navigating these exact issues. They make sure the plan is actually tailored to your life. They know where all these trap doors are.
So if you want to make sure your safety net is real, you can call Mansoor directly. His cell is 778-898-3202. That's 778-898-3202. Or you can email him at mansoor@munirus.com. The website is just munirus.com. Seriously, don't leave this to chance.
And before we wrap, there's one last big fear we should probably address. What if the insurance company itself goes bust?
Right. The sources mention something called insurers.
Yes, Assurus is the Canadian nonprofit that protects you if your life insurance company goes bankrupt.
So it's like deposit insurance for your bank account?
Very similar. If your insurer fails, Assurus guarantees you'll keep up to $200,000 or 85% of your death benefit, whichever amount is higher. So you're not left with nothing.
That's good to know. So even in a total corporate collapse, there's a backstop.
There is. And one final bright spot. In Canada, the death benefit that gets paid out is generally tax-free.
The CRA doesn't take a slice.
Not from the death benefit. It's one of the very few ways a large amount of wealth can be transferred without triggering immediate income tax.
Okay, that puts a lot of this in perspective. We've covered a ton of ground.
It brings us to a final thought that was in the research material. It's the philosophical difference between insurance and assurance.
I've always used those words interchangeably.
They're a little different. Insurance covers something that might happen. A fire, a car accident, you hope you never need your fire insurance.
Right.
Assurance covers something that will happen. Death is a certainty. The only unknown is when. So life insurance is really life assurance.
That really changes the framing. It's not an if, it's a when.
So the question to leave everyone with is this. Do you have a policy that you just hope will pay out? Or do you have the assurance that your safety net will actually hold when the inevitable happens?
Something to think about. Go check those policies, everyone. And thanks for diving deep with us.
Until next time.